Yeah, hi, everyone. So today's session is for the basics for stock market and options for the beginner. So basically, I'm going to stress more on the options for the beginners uh, with the introductory talk about the stock markets basics. If you have any questions, you can type in the chat window and I will try to take along with the topic. Or if it's like a, different question than the topic, then I will try to answer at the end of the session. So let's start our session today. So let's go through the disclaimer first. This is not financial advice. The information in this YouTube channel WhatsApp group is for educational and information purpose only and does not constitute financial advice. Please consult with your professional financial advisor to determine what may be the best for your individual needs. All investment involves risk including the loss of principal. The content provided is for information purpose only and should not be considered a recommendation to buy or sell any security. Today's agenda, we are going to cover these particular topics: what is a stock, what is a stock market, what is an option, key terms about the options, why trades options, risk of options, beginner tips and common mistakes to avoid while trading the options. And there are some of the beginner rules and some of the rules, tips or mistakes what we do while trading the options. Yeah, so we will go through that. So so whether you are brand new to the investing in the stock market and curious about the trades use options traders use the options, so today's session we will try to simplify the basics of those particular topics. As I mentioned earlier, stock market, I will go through some basics, but uh, by the end of this today's session you will be knowing, I think you're going to be very well educated about the options. That's the agenda of our today's session. So by the end of this webinar, you will understand what stock markets are, how the stock market works, what options are, calls versus put, risks and rewards, beginner mistakes to avoid. So what is a stock? A stock means ownership in a company listed on public stock exchange. So there are two types of companies. One is private and another is the public. So private company is something like which is owned by some family owned business or some small group of investors. But whereas the public company, when it says the public, then that company is listed on the stock exchange. And these companies do have to disclose their financial details publicly. This is a whole big topic about public and private, but today we are just looking into this one. So for this session, at this much is enough to know for today's. So when you buy one share of company like Apple or Tesla, you become a small owner of that business. So basically it's a public company listed on the stock exchange, and when we say the listed, so basically uh, they list their companies with the ticker, and they list with like a millions of shares or billions of shares. That's a different. But when you buy one share of that particular company, so you can consider yourself as the owner in that particular company. So for example, Apple stock. So when you buy one Apple stock, so you have the ownership of the Apple. Same with the Amazon stock or Google stock. So whenever you buy a stock of that particular company, so you can consider your small ownership in that particular business. You can have one share, you can have 10 share, you can have the 100 shares, or you can have the 100,000 also. So based on your number of shares, the percentage of your ownership is considered in that particular company. But for now, we will try to keep it simple. So why do stock price move? These questions come. So this is about the shares. What's the stocks? The stocks is nothing but your ownership in that particular company, and that's based on the how many shares you are owning of that company. Now, why do stock price moves? So basically the stock price moves based on the events. So like price changes because the company earning. So whenever the company declares their earning, so every quarter they have to declare their earning. Earning is nothing but the what is the profit and loss in short, and or how much business that company did, okay, all sort of thing. So based on the company, if the company earnings are good, the price will move and the company shares goes up. If the earning is bad, so basically company is not making profit, so in such a scenario chances are there the stock price may drop. Or some sudden news. So sometimes the news comes like that the CEO is resigning, or their CFO is resigning, or like they are appointing some new CFO, or like the CEO of the company, or they got some big contract, some new contract. So those are some good news, are there some bad news. So based on those particular news also, the price for the stocks goes up and down. Same with the economy. So when that, but just take the example of like in today's scenario now, where the oil prices are fluctuating. So in such a scenario, the stock relevant to the oil sector, it get impacted, and based on that the price movements apply. Same thing, the supply and demand. So if the supply is less, the price may go up. If the demand is more, then supply will go up. If the same thing in the supply also, it changes. Supply is more or supply is less. Again, the another factor comes, the investor emotions. So these are the things like it drives the price of the stock. So as per as the investment point of view, what is the goal of stock investing? Why we invest in the stock, or the traders, the retailers, or any investor, why they invest in the stocks? Or so basically to make a profit out of it, and everybody wants to buy the stock at the low price and sell at high, so that they can make a profit from that particular stock. Or in some cases you can buy the stock and hold for a longer time, maybe year or 2 year, and you may have some projection or some knowledge about that particular sector. You know that maybe over the time that particular sector will going to grow. Like in today's scenario, like AI, artificial intelligence, everybody thinks the tomorrow's world is going to drive by the artificial intelligence. So everybody try to invest into the AI today. So when that particular sector will start expanding, there will be demand will going to increase, and in that particular scenario the stock price will going to drive. So for long term investor, that's the goal for them, to buy today, hold it for a couple of years, some long period of time, and when they think that now it's like a peak of that particular sector or something like that, sell that for the high price to make a profit out of it. So this is about the stock. Hope you understand. If you have any questions, please type in the chat window. I will try to answer it. What is the stock market? So stock market is where buyer and seller trade shares. So as I mentioned earlier, so company listed their stock, their company on the exchange, public exchange. And public exchange is the media to buy and sell the security of any company. So basically the company lists their company on exchange, and the retailer goes to the exchange and buys the stock of that particular company. So that's the it's like a mediator in between the company and the buyer or retailer or investor. So popular exchanges: New York Stock Exchange, Nasdaq. These are the two exchanges. There are a couple more, but these are the one. And to make this particular handshake, there are the brokerage firms which perform the work of handshaking. So the retailer or investor, they open their account on the brokerage firm. Here the example is like a Fidelity or Charles Schwab, and there they provide the data from the exchange to us, and we do our transactions there. So Fidelity is the one who do the job of doing the handshaking. The key terms for the stock market is the ticker symbol. Ticker symbol is nothing but the company which list, they have to give some symbol to their particular security, the shares. So for the example purpose, we will take the Apple. So for the Apple, ticker symbol is AAPL. What is bull market? When the prices goes up or rising, that's the bull market, and when the prices are falling, that's the bear market. Volatility. So when volatility is it's a overall also, for overall market also, and in some cases is for individual stock also. So when there is some economic news, like just take the example of the Apple. For the Apple, like when they release their new iPhone or something like that services, so at that particular time, people think that this particular iPhone will going to make a more sale or something like that. That time everybody were rushed to buy the stock. So in that particular scenario, the volatility increased for that particular stock. In another case, like the any like a big global news happen, in such a scenario, that impacts the whole market. So basically you will see the volatility across the market. So in that case, you will see the indexes and all other individual tickers also get impacted with that one. So this is about the stock market. Now what is an option? So this is the topic we are going to go a little bit deeper. So now you understand the share. So an option is a contract that gives you the right, not obligation, to buy or sell a stock at a certain price before a certain date. Now think it is like reversing a future price, reserving a future price. There are two main types, call option and put option. So call options, these are the two mains. There are another strategies, but those are the different things. But these, as far as the option is concerned, these are the basics, call and put. So call options gives you right to buy a stocks. So use when you think stock price will go up. So one particular call option or one contract, first thing. So whether it's a call option or put option, it's called as a one contract. So one contract is consists of 100 shares basically behind the scene. So if you just take the example, if you are owning 100 shares of any like Apple, and now you want to hold that particular share for a long time. So basically you're not going to gain anything from your day-to-day holding. The price will go up, price will come down. Today's went up, tomorrow it may come down. But basically in your account it will show plus and minus. But if you see, you're not making anything out of it. So big institutions or like some of the traders, long-term traders also, they are holding stocks in like hundreds or thousand. So basically from with holding, they are not holding the stocks, they are not getting anything out of it. So from that particular idea, the big investors, they come up with this particular option strategy. So option strategy is that if you are holding 1,000 stock of any particular company, then you can able to sell the call option on those particular security. So how is that? So we will go in example. So with the is one contract equals to 100, he can able to sell particular option. He's selling, not buying. So he's going to sell the option which is available for the buyers. In simple term, we will go in the deeper afterward. So the call options. So call option give. So when whichever the buyer is there, in which scenario he wants to buy the call option, when he thinks that the price for that particular share, that security will go up. Just take the example, current price for the Apple is 100, okay, and you buy 105 strike price call. If Apple goes to 120, your option gains 100. Okay, now we will come back to this topic, but I will go to the next slide to explain some basics underneath this one. So for that, any option, there is a strike price, expiration date, and the premium. These are the basics for the options. So let me pull the real-time option chain, where you can able to see what those are. So this is a option for Apple. Now this particular option is expiring on 27 April 2026. So this is the expiration date for that particular option. Now the current price for Apple is 271.06. So this is the price it's closed on last Friday. Now if you are seeing the strike price, these are the strike prices, nothing but the Apple price. Okay, so these are the different strike price. So here the closing price for Apple on Friday was 271. So basically if you say the 270, this is the price. So this particular options strike price is incrementing or decrementing with 2.5 points. So if you see here 270, then downward 267.5, 265. Same thing on upside, 270, 272.5, 275. So it's incrementing or decrementing by 2.5. Now this is the strike price, which is nothing but the actual price of that particular stock at that current time. This is the expiry date. So expiry date is nothing but this particular contract is going to expire on this particular date, which is here is a 27 April 2026. Now, and this is the bid and ask price. So this, how much is the seller is asking and how much is the buyer is ready to pay for it. So for right now, strike price is what we want to look, and the expiry date, and this is the price. So these are the three things for right now. You will got it. We will go back to example. We will come back again here. So this is the strike price, the agreed price to buy or sell that particular share. Expiration date, last day the option is valid. After that day, that option is not valid. And the premium, the price paid to buy the option. So this is the price. So the last particular the retail price, last particular contract got sold on Friday at $1.07. Okay, so this is the price. So that's called the premium also. So premium. So example is given here. If the premium is $2.50, then real cost for that particular to buy that particular option is 2.50 multiplied by 100 equals to 250. So what is this 100? 100 is nothing but one. Usually it's mostly you can say in 99% cases it's a standard. One contract equals to 100 shares. One contract equals to 100 shares. Now here whatever you are seeing this thing, this is nothing but the contract actually. So whatever the price we are going to pay is for to buy this one, it's for one contract, and one contract equals to 100 shares. So this is about the basics. We will come back again. We will go back to our previous slide. So now here we have to see. Now the current price of Apple is Apple is 100 right now. Current price of Apple is, for the example purpose, is 100. So you will going to buy the call option of 105 strike price. This is nothing but the strike price 105. If Apple goes to 120, anywhere above 105 it goes. Okay. So if Apple goes to 120, your option gains a value. So for the call option, that particular stock needs to go upside. Then only you will going to make a profit in that particular call. Same thing for the put option. A put gives you the right to sell stocks. Basically, use when you think stock price will go down. So when you think that, oh, the Apple price may go down, in that case you try to buy the put. So if the price goes down, then you will going to make a money. Whereas in the call option, when the price goes up, in that case you will going to make a money on that particular option. So hope you understand call and put. So, and for both of them, this particular component, the strike is same, expiration and the these are the premium for them. Okay. Now there are some of another terminology: in the money, at the money, out of the money. So what is the in the money? So when so in this particular example, the Apple price was $100 when we decide when the retailer decide to buy the call of 105. Okay. So when the Apple price goes to 106 or anything above 105, that means that is called the in the money. For example purpose, we will see. Now here 270 is the price for Apple. So when we say in the money, so 270 is less than the current price. That means that price, strike price is under the current market trading price. So these are all these. If you see this particular color here, this dark color, these all strike price are in the money in the call. In case of call, these all are in the money, because these all strike price is less than 271, the current trading price. That's why these all calls as a in the money. In the money has intrinsic value. Now call means stock price should be greater than strike. Here stock price is greater than all this strike price, and that's the reason it has some intrinsic value. What is at the money? Stock price near strike. So if you see this one, 270 is inside, but 272 point is nearby. So this is called the at the money. In call case 270, for input case this is the at the money. Okay, just near to the in the money. Same thing out of the money. It has no intrinsic value yet. Stock price is less than strike price. other way around in the put. So if you see 272.5 or like anything greater than this one, it has, this is called the out of money, because right now it doesn't have any intrinsic value, because currently the stock is trading at 271 and these strikes price are greater than the current trading value. That's why it doesn't have any intrinsic value. Same thing, this is in the put case, it doesn't have any intrinsic value. Hope you understand till this point. If you have any question, yeah, you can just put it in a chat. Now, why trade options? That's the question. So people trades option for numerous reasons. One is the leverage. So controls 100 share with less money. So what happens when we say leverage here, control 100 share with a less money? Now just take the example. If you want to buy if you want to buy 100 shares of Apple, now take the example how much you want to spend to buy the 100 shares of Apple. 271 multiplied by 100. So basically you need around like a 27,000 to buy the 100 share of Apple. Whereas if you decided to buy the call option for Apple for 270 strike price, you just need $234. Basically 2.34 multiplied by 100. If you see here, real cost for right now. So this is the premium multiplied by 100. So here is the premium is on the ask side is 2.34. So 2.34 multiplied by 100 means 230. So right now, if you decided to buy, you have to just give the $234 only. So at current scenario we don't need, but and after that you decide like at the time of expiration on the like a 27th, which is Monday, tomorrow, by end of day 4 o'clock, if the price stays above like a 270, so in that case if the tomorrow's Apple price closes around 280, which is 270 is inside, it will be in the money. So in that case, at the end of the day, if you decide to buy, if you don't need to buy, by 3 o'clock 59 minutes, you can sell this particular option for that particular premium, whatever the price at particular time. But basically, initially you from the leverage point of view, initially you just paid $2.34 to buy that particular stock for right now. When today it closes around 280, you can exercise this one. What is mean by exercise? So basically you have to pay the 270 multiplied by 100, which is nothing but the 27,000, and you can exercise things. So when you exercise this particular thing, basically you will going to get this particular share in your account. You will going to owning that share. So at the end of the calculation, if you see, you paid to exercise 27,000 plus the premium, which is 234. So basically you paid 27,234 to buy those particular 100 share, and you got a 1 day. Okay, and as it closes at 280, basically if you see 270 plus 234, so basically you got this particular share for 272.34, and the current price is trading 280. So basically you are in the profit of around like a $7.5 in that case, and you don't have to pay upfront. But just take the in another scenario, if the price goes down tomorrow to 260, basically you will going to lose this particular premium, okay, which is $234, and instead of and you just lost the $234 whatever you paid as a premium. But if instead of doing buying the option, if you decide may have decided to buy it for 270, you may have lost in the $10 instead of 234, and your even 26,000 fund also cash amount may have stuck in this particular stock. So that's the benefit of buying the option. So the one of the thing is leverage, another is the hedging. In some cases what happens, the people, like when they buy they decide to hold their particular stock for the long term, and they may anticipate some news just like the earning or some like phone releases by Apple, and they think that the price may go up or go down. So to hedge that one, hedge is nothing but that, because if you have bought some that Apple for 217, if that stock price goes to like a 220, you're going to lose around like a $50. So what the people do, people instead of to cover their risk, they invest in the put. So they think that okay, I will invest into the put so that it will be covered. Even the stock price, it goes down, it will be negative, but they try to recover from buying the option. It is called the hedging. Also the income. So some people who decide who holds their particular stocks for long term, so they are not making any money unless and until you sold that particular stock or security. You will not going to see the profit or loss of that one. So there is another what I can say. Yeah. So what the people try to do, instead while they are holding, they sell the covered call on those particular things. So just take example, if you have the 500 share, you can able to sell the 5 contract. One contract equals to 100 share, and they collect the premium. So this particular value is nothing but the premium. So user pay this particular premium to buy the option, and the seller who is owning that particular stock, they sell the covered call on those particular stocks, and they collect the premium. And by any mean, if that particular option get into the in the money, and if the buyer decide to exercise one, then the whoever is selling that covered call, he has to sell that particular shares on the agreed price. That agreed price is nothing but that particular strike. Here in this case, like I take the example 270. Hope this understand covered calls. Risk of options. Options are powerful, but it's very risky. You can lose 100% of premium paid. So what it mean by I can lose 100% of premium paid? So just take the example like now somebody bought this particular 272.5 call for $1.11 as a premium. But tomorrow if this particular Apple closing price is around 270, then this particular 272.5 will not have any intrinsic value at the end of the day. So it will going to be 0. So that means that you can lose 100% premium paid for that one. Time decay hurts option daily. Now when the expiration date comes nearby, the price get decay actually. So when it's come near to the expiration, the prices goes down if it's out of money. I'm not talking about the in the money. So if it's out of money, and as the expiration is reaching, it decays the price actually. Even like if the today it's showing 272.5, $1.11, but tomorrow, like when on Monday when the market opens, and at 4 o'clock, if the stock price is at like a 271.06 only, you will see around like a 3 o'clock or 4 o'clock, this particular 272.5 call options premium will be around like a 10 cents or 20 cents also. So we, that's the time decay for that one. Fast price movement. So fast price movements is like when the volatility for that particular stock or uh, for that sector is there, like volatility. So when the volatility means like the some news came and suddenly uh, people rush to buy the shares for that one, or try to want to sell because of some negative news. So if in that particular scenario this volatility goes up for that particular sector or for that particular share, which drives the price fast up and down. That's called the fast price move. Emotional trading losses. This is the particular completely different topic, but same thing. While you are trading, you cannot be emotional with your trade, because if if the person loses, then definitely his emotions will going to hurt. Whether even if it's make the money, it will be other way around. So uh, trading options, you have to first educate yourself, and then only you can start. But if you start uh, doing the options trading, yeah, so you have to be well educated about all these facts. So what are the so these are some of the learnings from my past. As a beginner, you should learn first, trade later. So give some time, know about the market option, get some depth knowledge about the options also, sectors that particular share. First try with the paper trading account. So you with most of the brokers, they give you the paper trading account. It's like a demo account, and you can try there. Like this is also the simulated account actually. It's a trading account. It's a paper trading. Now here, now if I'm a beginner, I want to know how to buy the option. So I will go here, I will say right click, buy single. These are the complications, we will not go. So go on single, then here it is showing, okay, how much is the quantity? 10 quantity, but no, I need only one quantity. So I am saying one quantity. What is the strike price? 272.5. What is the type? Call. What is the premium I am paying? 1.11. Confirm. Now here once I come to the confirm, it is showing, okay, what is the commission. So along with the premium, you have to take in consideration of the premium also. For while buying also, you have to pay 0.65. While you are selling, you have to pay the 65 cent. So on paper trading account, you can go and do the practice before doing the actual trading. Risk small amounts. So this is everybody's appetite, but start small. Never chase hype trades. So like that, there are the hypes. Okay, this will go this much. It will happen. This will happen. So don't go on all those things. Okay, educate yourself. If you have the knowledge about that particular stocks, well known, like a fundamentals and all, yeah, then only look into that, or let the whatever the hypes are going around in the market, let it settle down, and then think about it. Focus on risk management. So same thing, options are very riskier, as it's already, we can say it's like a main risk, can lose 100% premium. So manage your risk. Okay, focus on your risk. Okay, how much you can offer to lose. Keep your emotions controlled. These are the most of the traders go through this thing. So these are the beginners tips. Golden rules for options. Start with one contract. Use liquid stocks. When we say the liquid stocks, basically the options which have the more volume on the daily basis, buy those stocks only, because in some cases you buy some stock and just take the example here. Let me see. Okay, so if you see here the volume, see this is the volume traded. So 28,000, 23,000. So these are the open interests. So these are the contracts still open for tomorrow. So it has good liquidity. If we go on some let's see, I will see this particular one. So if you see here, volumes are like 11, 2, 3 in whole day. These are the volumes for whole day. So even you are see, buyer is asking for 780 and seller is for 1020. So there is a difference of around like a $2.40, big difference, because the volume is low, so very liquidity is very low. Yeah. So you have to search, you have to trade a stock where it has a good amount of liquidity. Use liquid stock. Choose defined risk trades. Okay. Manage position early. Same thing, or learn before scaling. So if you know that, okay, like how here as mentioned on the risk management, if you see that particular price is burning the premiums or like it's going down, and you know that, okay, I can risk this much only, so manage your position, maybe sell that one, or what to do, you have to think on that one. Yeah, so that's the manage position. Avoid these mistakes. So while as a big new option trader, you should avoid buying the daily weekly options blindly, because dailies are very very risky. Weeklies you will have the 5 days time. So what is this daily and weekly? Basically there are types of option. If you see here 27, 29, 1, so these are the alternate day, Monday, Wednesday, Friday. Whereas if you see, these are the ETFs related to the index. It has 27, 28, 29, 31. So it has daily expiration. These are very risky options are there. There are the options which are like weekly only. So if you say 1st May, 8th May, 15 May. So these are the weekly. This expires on the Friday. Like Apple is expiring alternate day. This is relevant to the S&P 500. These are expiring daily. So you have to avoid those things. Trading early without plan. So do in-depth study of that one, have the plan, and then only trade. Don't using all accounts on one trade. If you have $100, don't invest all those $100 on one trade. Okay. So plan accordingly. Ignore time decay. So that's the main thing for that one. Revenge trading. So when the revenge trading is nothing but when the people lose some money, they try to recoup that money. Oh, I bought some option and then I sold early. I lost like 10% of my account. Now I want to gain that one. So they invest on some another particular shares, like options or shares. In revenge trading, it's like without thinking, in hurry actually. So people lose more money there in those cases. So revenge trading is not a good thing. So basically try to avoid the revenge trading. Common mistakes to avoid: buying random stocks from social media. On social media people do lot of hypes and all. If you don't know about that one, yeah, step back. Ignoring stop losses. So this is one, it's a bigger topic. So that's also we have to see. It's nothing but the okay, how much we can afford to lose, we have to see that. Trading options without understanding gigs. So definitely you should have some knowledge, try to learn from the experienced people, and that's the one of the thing. Revenge trading after losses, this is the same thing. This is the revenge trading. So these are some of the things which helps you to be a better trader. Final summary: stocks is nothing but the ownership in company, option, contract based on stock movement. Stocks are generally safer for beginners. Options can grow faster but also lose faster. Final thing: education first, profit second. Uh, that's all about from me. Let me know if you have any questions. I will try to answer. Yeah. Could you provide the name of the trading platform you are using and which ones are better? Okay. So, Charles Shop and Fidelity, both of them I mentioned. Uh, yeah, Fidelity and Charles Shop. Now, the Fidelity is a little bit conservative, uh, but if you are aggressive trader, I can say go with the Charles Shop. But for beginner trader, I can say go with the Fidelity. They are better one. Yeah, because Charles Shop, some of the options are there, which Charles Shop will allow you to trade till 4 o'clock, whereas with the Fidelity, they try to close your options by 3:45, so to mitigate the risk. So there are some of the plus and minus, but they are conservative. So uh, if they think that this particular share or script is risky to trade, basically they don't allow their traders like the 0 day trading, like 0 DT is nothing but the option which is expiring on the same day, like just take the example like SPY. So tomorrow morning, tomorrow is the 27th, so 27, if tomorrow morning if you decided to buy call or put option of that particular SPY, Fidelity won't allow because it's very risky trade. So they don't allow their user, retail trader or entry level beginner trader to buy the option for this particular one. Whereas you can able to buy the next day on 28. Whereas in the Charles Shop, they don't care. Even on 27 tomorrow 3 o'clock, if you decided to buy, so you can take more risk. So whereas in the Fidelity they are like a little bit conservative. So it's up to individual, but those are the plus and minuses. Any other questions? I think yeah, that's it from my side. All I think so. If okay, simulated training, nothing but it's a paper trading. So with any trader, if you go with the Fidelity or Charles Shop, there are two types of trading accounts. One is a live trading account and another is the paper trading. So let me show one thing. Simulated trading. I will close this one. Yeah. So let us. One minute. Yeah. So this is the login screen for Think or Swim. That's the desktop platform for Charles Shop. So here is the live trading you see. So live trading is nothing but yeah, live data, and this is the paper money. So when you say click on the paper money, it's a simulated trading. So just now what I shown to you, that's on the paper trading account I shown. I have not logged into the login. So when you do the actual trading, you have to do it on the live trading. And for the paper money, this is the one. So for each and every broker, they provide you with the paper trading and live account. So in the paper trading, they give like some X amount, and then you can use that to play around. Like just now, whatever I shown to you, you can buy that. You get the actual feel. You can able to buy that one, and it's only in the regular hours only, and you get the feel of like you're doing the real trading actually. So that way you can practice yourself, get trained, and then start on the live trading. Any other question? No. If not, uh, thank you. I will end the session.